When financial success conceals capability loss. Introducing SMCCS and the Finance Capability Admissibility Engine. The problem? A company reports higher profits. Its share price rises. A public utility keeps charges low. A hospital completes a financially successful transaction. An organization cuts costs and reports greater efficiency. All of these outcomes can appear successful when viewed through conventional financial indicators. But another question may produce a very different picture. What happened to the underlying capability? Was infrastructure maintained? Were productive assets renewed? Was workforce knowledge preserved? Were environmental obligations met? Did the institution remain resilient? Or was part of today's financial success achieved by consuming the capabilities required for tomorrow? This is the problem addressed by a new analytical framework developed by the Philosophical Intelligence Institute. It is called the Scanlon Murphy Capability, Claim Synthesis, SMCCS, and PII has operationalized that framework through a new analytical engine. The Finance Capability Admissibility Engine. Part 1. The distinction that changes the analysis. SMCCS begins with a distinction between two things that are frequently treated as though they were the same. The first is underlying capability. This includes productive infrastructure, equipment, and operational capacity, but it also includes people, skills, knowledge, and institutional memory. It includes environmental resources and restoration requirements, and it includes social and institutional capabilities such as trust, regulation, public service capacity, and organizational resilience. The second layer is financial claims, shares, debt, mortgages, leases, dividends, buybacks, financial valuations. These claims are economically real, but they are not the underlying productive capability itself. Ultimately, financial claims depend upon systems capable of generating the future resources from which those claims can be satisfied. That leads to a central SMCCS principle. Financial claims derive sustainable value from underlying capability. The distinction matters because the two can move in different directions. Financial value can rise while productive capability deteriorates. Reported profits can improve while maintenance is postponed. Distributions can increase while debt and fragility increase. Costs can fall while workforce capability is being exhausted. When this happens, recorded financial success may no longer tell us whether genuine economic capability has been created. In pre-labut financial valuations, these claims are economically real, but they are not the underlying productive capability itself. Ultimately, financial claims depend upon systems capable of generating the future resources from which those claims can be satisfied. That leads to a central SMCCS principle. Financial claims derive sustainable value from underlying capability. The distinction matters because the two can move in different directions. Financial value can rise while productive capability deteriorates. Reported profits can improve while maintenance is postponed. Distributions can increase while debt and fragility increase. Costs can fall while workforce capability is being exhausted. When this happens, recorded financial success may no longer tell us whether genuine economic capability has been created. Part 2. From SMCCS theory to the FCAE analytical engine. SMCCS provides the theoretical framework, but PI wanted the theory to do more than describe the problem. It needed to become operational. That led to the Finance Capability Admissibility Engine. FCAE asks a deceptively simple question. Did the financial gain arise from creating and maintaining capability, or from monetizing its depletion? This is not an anti-finance test. It does not presume that profits are bad. It does not presume that dividends, share repurchases, mergers, debt, or private investment are extractive. Finance can create capability. Finance can preserve capability. Finance can enable transformation. And financial distributions can be entirely legitimate. The purpose of FCAE is to distinguish these situations from cases in which financial returns are being supported by the under-maintenance or consumption of the system beneath them. The Capital Maintenance Admissibility Test. At the center of FCAE is the Capital Maintenance Admissibility Test, CMAT, before treating a reported financial surplus as evidence of genuine economic gain. CMAT asks what had to be maintained first. It examines several dimensions: physical and productive capability. Were machinery, infrastructure, technology, and productive systems adequately maintained and renewed? Human capability. were skills, knowledge, health, staffing, training and workforce resilience maintained, environmental capability, were resource depletion, restoration obligations, and ecological costs recognized, social and institutional capability, were trust, institutional knowledge, public service capability, and regulatory integrity maintained, and finally, financial resilience. After financial value was distributed or realized, did the organization still possess sufficient liquidity, solvency, and investment capacity to remain viable? This changes the meaning of surplus. A financial statement may say that money is available for distribution. FCAE asks whether some of that apparent surplus should first have been required to maintain the capabilities responsible for producing it.
Part 4. Capability. Claim divergence. SMCCS calls one particularly important failure condition. Capability, claim divergence, CCD. CCD occurs when financial claims or financial value rise while the underlying capabilities required to sustain them become materially weaker. Imagine this pattern. Financial valuation rises, distributions rise. Reported profitability rises, but at the same time, maintenance falls, investment declines, the workforce loses capability, infrastructure deteriorates, or institutional resilience weakens. That does not automatically establish extraction. SMCCS requires evidence connecting the financial decision with the capability effect. But when that connection exists, something important has happened. Finance is no longer simply being supported by capability. Capability may instead be being reorganized to support finance. That is the critical inversion. Part 5. What does FCAE actually conclude? FCAE is designed to discriminate between different outcomes. A decision can be capability creating. It can be capability maintaining. It can merely transfer ownership of capability. It can transform old capability into something new, or it can become capability extracting. And where the evidence is insufficient, the correct finding is simply undetermined. That last category matters. An analytical framework should constrain conclusions as well as produce them. When natch the like shelving made for of Edbrid suff of time, when that alive to go and nessin with you. Part 6. Testing the engine. PI therefore tested SMCCS and FCAE against deliberately contrasting cases. The first case examined share repurchases by Costco Wholesale. The purpose was important. If the framework simply classified every buyback as extraction, then it would have failed immediately. But it did not. Costco was continuing substantial capital investment, generating strong operating cash flow and retaining financial resilience while making the distribution. Within the defined transaction boundary, FCAE classified the repurchase program as capability maintaining rather than extractive. That demonstrated discrimination. The second case examined Steward Healthcare. This case was considerably more complicated. Earlier private investment had helped rescue distressed hospitals and finance substantial improvement. FCAE therefore did not classify the entire ownership history as extraction. But a later transaction monetized essential hospital real estate, converted those assets into long-term financial obligations, and simultaneously generated substantial distributions to owners and management. FCAE identified a transition from an earlier capability-creating phase to a later capability-extracting financial structure. The third case moved outside conventional corporate finance. PI examined Aurora Energy in New Zealand. Regulatory evidence showed historic under-maintenance of electricity infrastructure followed by a substantial later program of corrective investment. This exposed an intertemporal problem. Maintenance avoided or deferred in one period can become a financial burden inherited by another. But the case also produced an important correction. The evidence did not establish that shareholder dividends themselves caused Aurora's underinvestment. PI therefore narrowed the finding. The maintenance deficit was established. The deferred burden was established, but strict causal attribution from dividends to deterioration remained undetermined. This mattered because a useful analytical engine must be capable of correcting its own overreach. Following these tests, SMCCS advanced to PI-controlled validated status. Part 7. The Surplus Reclassification Problem. One of the most consequential implications of SMCCS concerns the meaning of surplus itself. Suppose a company reports $100 million of profit, but during the same period it postpones essential infrastructure replacement. It reduces training. It exhausts employees. It transfers environmental restoration costs into the future. Or it increases financial distributions while weakening organizational resilience. Was the entire 100 million really income? SMCCS introduces the Surplus Reclassification Principle, where apparent surplus depends upon consuming capability that should have been maintained. Part of that surplus may more accurately represent capital consumption or capability liquidation. This does not mean that capital must never be consumed. Old technologies sometimes need to disappear. Factories sometimes need to close. Organizations sometimes need restructuring. The requirement is more fundamental. Do not confuse the liquidation of capability with the creation of capability.
Part 4. A new way to understand. Financialization thus also allows SMCCS to formulate financialization more precisely. Financialization is not simply the existence of banks, markets, or financial instruments, nor is finance inherently opposed to productive economic activity. Under SMCCS, financialization becomes a governance condition, when the creation, protection, and realization of financial claims increasingly determine resource allocation, even where doing so conflicts with maintaining the capabilities upon which those claims ultimately depend in its healthy form. Finance serves capability. In its financialized inversion, capability increasingly serves finance. That is the distinction FCAE is designed to detect. The Finance Capability Admissibility Engine can be applied far beyond corporate share transactions. It can examine public infrastructure, healthcare, utilities, housing finance, private equity restructuring, organizational cost reduction, debt-funded acquisitions, education, workforce restructuring, environmental depletion, public sector expenditure, and social policy. Anywhere there is a tension between present financial performance and future capability, FCAE provides a structured method for examining what is actually happening. Financial success tells us something, but it does not necessarily tell us enough. A system can generate impressive financial results while consuming the productive human, environmental, or institutional capabilities that made those results possible. SMCCS provides the theory for understanding that relationship. FCAE provides the analytical engine for testing it. And the central question remains, did the financial gain arise from creating and maintaining capability, or from monetizing its depletion? The Finance Capability Admissibility Engine, developed by the Philosophical Intelligence Institute, frameworks turn complexity into admissible decisions.